Hello, this is Jordan, and this video update is being recorded on the afternoon of Monday, December 12th, 2016. Thank you for tuning in. And today in this video, I'm going to talk about the impact of the stock market on gold and some of the similarities I see between 2015 to 2016 and 1998 to 1999. And starting off, here in this chart, we have the S&P 500 and we have gold at the bottom. And in my book, I talked about the long-term negative correlation between gold and stocks that's well in place. And that kind of deviated a little bit in the first half of 2016, where stocks and gold were positively correlated until the summer. But when bond yields began rising, there was a sell-off in both markets, but a bigger sell-off in gold. And then that really accelerated with Trump being elected. And of course, that sell-off in gold accelerated while stocks bottomed and then surged higher and made a technical breakout out of a 2-year base. And I don't know what the S&P 500 closed at today. It looks like about 2257 if I round that up. This breakout has a measured upside target of about 2430. There's a Fibonacci target of about 2500. So I definitely see 8% to 10% upside. And it's even possible that it could go a little bit higher than that. I mean, if you look at going back to the 2009 low, we could be in a 5-wave structure here in the market where this 2-year consolidation was the 4th wave, and now we're in the middle of the 5th and final wave. And while in the very short term we could see a little correction for stocks, and I am short term bullish on bonds and golds, but other than that, and stocks perhaps pulling back a little bit, the medium term outlook, I mean, looking out over the next 3, 4, 5 months, just looks very bullish for stocks. They're very technically strong, and there's a lot of momentum behind the market. And obviously, from an investment standpoint, I mean, sentiment is getting way too bullish, and valuations are historically very extreme. Those things are very worrisome when we're looking, say, 4 to 6 months or 6 to 12 months into the future. But as far as the next couple months, I don't think they're going to negatively affect the market. It looks to be moving higher, and that is in line with the negative correlation and my gold forecast of gold going to retest the late 2015 low at $1,050 an ounce. And so gold really needs the stock market to peak or run into some problems before it's going to begin that bull market in earnest. Now, in this chart, we're looking at the similarities between 1998, 1999, and 2015 to 2016. And right here, this chart, we're looking at various markets from about 1995 to 2000, 2001. Now, we don't know if things will play out in a similar fashion. History repeats itself, but it doesn't repeat itself exactly or perfectly. I mean, as whoever said, history tends to rhyme. And if you go back to the end of this period shown here, the trigger for a bear market was really the bust in technology, the bust in the internet mania, and just an aging expansion. The economy was expanding, I believe, for 9 or 10 years to that point. So it was an aging expansion. And also you had extreme overvaluation. So those 3 things that I mentioned, we have 2 of those 3 right now. We have an aging expansion. We have the market very overvalued. The market's trading at 24 times trailing earnings, and that's according to the Wall Street Journal. And that's historically, and if you look back over the last 90 years or so, the 2000 peak was at 30 times earnings, so that was the outlier. But all the other peaks were around 22 to 24 times earnings. So what does that tell you if we're trading at 24 times trailing earnings? I mean, it tells you the market is really richly valued here. And looking at Robert Shiller's, the 10-year PE ratio, or the CAPE, that's in the 94th percentile right now. And if you look from, I believe, trading, so it's in the 94th percentile. In 1929, I believe it was in the 97th percentile. In 2007, it was in the 95th percentile. And from those levels that I mentioned up to 100%, that was basically the year 2000 to 2001 and the tech bubble and bust. So again, that's a very long-term valuation uh, tool, and whatever you want to look at, if you just compare it to years and years of history, the market's really, really overvalued. But getting back to the comparison uh, between recently and 98 to 99, I've gotten a little bit away from that. But here we're charting the S&P 500, emerging markets, oil, the 10-year yield, and the U.S. dollar. And I have three vertical lines here. The first one is the bottom for stocks in 1998, and then the second one is when stocks peaked in March 2000, and the third one, that's when gold stocks bottomed. So just to uh, give you those lines and just some kind of perspective on the timing of when trends shifted and bottomed, etc. And the similarities, I think, are with oil and emerging markets, because oil made a major low right at the tail end of 1998. Oil was hurt because of the problems in emerging markets, in Russia especially. And emerging markets, of course, had a big sell-off from 97 to 98. Oil, again, as I said, it made a major low at the tail end of 1998. And the stock market also, I mean, it only corrected, I can't quite, this chart's a little bit small from where I'm sitting, but I remember the NASDAQ, I think the correction was about 20%, and there was fear that the bull market was really ending. I mean, remember when we went from the mid 90s to 97, 98, I mean, the valuations were really crazy, and people knew that a bust was going to happen, but it wasn't necessarily imminent. So even after that sharp correction in 98, the market continued higher for a little bit longer. And so, as I said before, I mean, the problems in emerging markets, the problems in oil, they were the trigger of that. And this time around, I mean, we see similarities, because oil had a huge decline in 2014, and that also emerging markets had a big decline, and the decline in oil also it hurt our economy, it hurt our market, because the energy sector sold off substantially, and in addition to that, the really strong dollar, that really was as big of a factor as oil, in my opinion. So as I said, I mean, things aren't playing out exactly, but it's important to keep in mind. And just looking at, and then the U.S. dollar was kind of trading in a range from 97 to 99. It was trending slightly higher, but it finally really broke out of that range and had a big breakout in early 2000. And of course, in recent weeks, the dollar has had a big, important breakout. And after the market bottomed, interest rates surged in 1999. Of course, we're seeing interest rates, they bottomed in the summer and they're surging. So there's a lot of similarities. That's not to say that the trigger of the next recession and bear market, I mean, obviously we don't have a massive bubble in technology, so it's not apparent what's going to be the trigger for that. I mean, I think the most likely thing is the dollar. If the dollar gets a lot stronger, I mean, the dollar index trading around 100, it's technically very strong. If we see a sharp move higher, that could, combine, that would continue to force interest rates higher, and interest rates could affect the housing market, and dollar strength. Too much dollar strength too quickly is a negative, because half of the S&P 500 companies, or not half, but 50%, I believe. I don't know if it's. I'm struggling with the statistic here, but I believe that S&P 500 companies on average get about half of their sales outside the U.S. So that's why the really strong dollar can be a problem. So that's something to watch. And then just looking at the timing from the low in 98 to the peak in early 2000, if I apply that timing going forward, that would have the market peaking, the stock market peaking around the summer of 2017, with gold stocks possibly bottoming around the same time. Now, talking about gold and gold stocks, that's a separate video, but I do think we've already seen the low in gold stocks. I don't think it's possible they could retest the low. I don't think they're going to make a new low, but gold I certainly am bearish on in the medium term and think there's a chance it could make a new low. So these are kind of the things that I'm focusing on, and the dollar and the stock market now are really the key. I think the dollar has to get a lot stronger to eventually hurt the stock market and cause a bear market. And I mean, it could be caused by it could be caused by inflation, or it could be caused by the economy getting weaker. Either or would be a catalyst for gold, but we can't say what it's going to be yet. But as I was saying, those are really the two key markets to watch. Uh, as far as all these things I'm talking about, the stock market and the dollar. And again, still the way these things are setting up over the medium term, it still looks bearish for precious metals. Now, the last chart I have, I mean, I have a lot of, I shouldn't say a lot, but I have several new analog charts that I'm working on. In this one, we're looking at gold's decline from secondary peaks. Gold's major peaks right now were, of course, in 1980, 2011. And after those peaks, gold declined, but then it rebounded back and made a lower high, or you can call it a secondary peak. Back at the end of 1980, its secondary peak was almost at $750 an ounce, and then in late 2012, its secondary peak was $1,800 an ounce. So we're plotting the declines from those 2 points. I mean, we plot the one from 1980, and we compare it to the one from 2012. And obviously, gold, as far as price, is holding up a lot better. If it follows the same path, then it would bottom in April 2017. I mean, looking at the stock market, the last slide I mentioned the summer is a possible turning point. Last point on this chart, I drew two circles there which show potentially where gold could be if it's following the same path. Now, that would suggest a bottom not as quickly as spring next year. Now, I'm not, other things I'm looking at on the analogs, I'm looking at the longest bear markets for gold and silver, and then bull markets in the US dollar, and they all, I mean, looking at the longest bear markets in gold and silver, they're really about this long. So we're probably going to reach record territory as far as time for these bear markets. They don't necessarily have to make a new low, but if they just keep going without really rising for a while, that counts as far as a bear market in time. So I know there's a lot to chew on in this video, but these are some things that I'm thinking about right now and researching, and that's all I have for you today in this video. But you can follow all my work at thedailygold.com. You can opt in there for my free newsletter. Thank you so much for listening and watching to this video, and I hope to have something again published, another video in the next week or two. Thanks, everyone.